Welcome to the Win, Make, Give podcast, season 2. I think it's been a while. What episode are we on? I don't know. Don't answer that. We're really deep into season 2. Ladies and gentlemen, this is Ben Kinney. I'm joined here with Bob Stewart and Chad Himes. Hi, guys.
Ben
Hello,
Kinney.
Ben.
How you doing?
I'm doing good.
Awesome.
I'm really hoping, Dave, the man in the back, the silent guy, maybe we could get this episode out before the end of the year. Why? Because it's super timely. And if you do not get it consumed before the end of the year, at least it'll help you for next year a little bit more. So there's a few things that happen at the end of the year. On January 1, what do we normally do, Chad?
I don't normally do anything. Most people flip their calendar and set goals and resolutions.
Do you watch football or what do you do?
No, I don't do anything special on New Year's Day, actually. Nothing.
Oh,
I'm boring like
you
that.
hate New Year's resolutions?
New Year's is the single worst day of the year. I can't stand resolutions, the goals that get set on the first just because we flip a calendar. No, I'm anti New Year's.
Bob, what do you think?
Sorry, gang.
I mean, I'm a dad of young children now, so I'm generally doing our routine or whatever. But I used to enjoy New Year's. Yeah, I'd go out and have a little New Year's party, and
I spent most of my
college
teen years
football
not with my not with my friends. I was having to visit my father's on New Year's. It was me and Dick Clark. That was New Year's. So
All right.
I'm anti New Year's.
I like New Year's. I mean, I like the idea of the flipping of the calendar and the
You flip
the
it every month,
prospect that
Bob.
we could change our ways or be something different this next year. I think there's hope in that.
I think January 1, what we do is we throw away last year's calendar and we start a new one. But one of the things I think about is on January 1, how did I do last year? What happened last year? How did I do in business? How did I do financially? How was my life? What did I like? What did I not like? Well, it's kind of preparing us for something that happens. Is it March 15th or April 15th that our taxes are due?
April 15th.
April 15th. Our taxes is due. But here's the problem. Our taxes are due April 15th, but for the most part, from January 1 to April 15th, it's actually too late to do anything about it.
Correct.
So you have to do something about your taxes prior if you want to pay a little bit less to the IRS legally. Now, we've done a bunch of interviews in the past with Tom Wheelwright, the author of Tax-Free Wealth and my personal tax coach and consultant, but we've never done our own call on really a focus on paying less taxes. So today, I'm going to go through a bunch of what I consider some good, some bad, and some slightly ridiculous tax loopholes. So if you hate paying taxes, which I hate paying taxes.
I think everybody should.
Everybody hates paying taxes.
I think so.
Then
But likes driving on roads and likes bridges. So there's that.
thank you for our resident liberal. Ladies and gentlemen, the tax code was designed to incentivize us to do things that the government wants us to do. For instance, when you buy a house, there is a tax credit for owning a primary home. You get to write off the interest on your home when you own a house. Why? Because the government wants us to own houses. If you give money to charity, a legal charity, you get to write off the money that you give to the charity. Why?
Because they want us to give money to charity.
So not the human fund, Chad. Not
No.
the human fund.
Not the human fund?
Got to be legal.
Got it.
Okay. So today we're going to go through some of the best tax opportunities that if you invest your time or your money can save you the most amount in taxes.
Okay.
And then we're going to go through some of the most ridiculous ones.
Okay.
Does that seem fair?
That sounds like a lot of fun. Everybody loves when we talk wealth. Ben Kinney is going to lead us through another wealth-related conversation.
Okay. One of them is your medical bills.
Okay.
Now, annually, your medical expenses need to exceed 7.5% of your income in order to be deductible. However, thanks to a health savings account, HSA, Chad,
Got it.
you can effectively deduct all of your medical expenses starting at the very first dollar. Whether you incurred them this year, in years of the past, or potentially even if you want to deduct them in the future, so long as you have a high deductible insurance plan. An HSA works like an IRA. You don't have to pay taxes on the money you save and invest to pay for your future medical expenses. The funds in your HSA can be used to pay for medical expenses that occur after you open the account, regardless of when your contributions were made.
Okay, so what you're saying is I can make a contribution to an HSA
Right now.
today. I can put in, you're going to give us some numbers. I can put in up to whatever you're saying, tax deductible now. And then when I need that money next year or the year after for some medical procedures that are going to come in my life, I can use that money to apply towards those medical expenses.
Yeah. You,
Me.
Chad, can put in $7,100 in a year.
Okay.
Or an extra $1,000 once you hit the 55-year mark.
Not there yet.
I can put in $3,550 because I am unmarried.
Is there like it just keeps stacking, Ben? So like, let's say this year I put in $3,550. That's your single rate, and then next year you put in $3,550, and the next year you put in so I have $11,000 or whatever sitting in that HSA waiting to be spent on my health, some kind of health care in the future.
Exactly. And you can actually invest the money that you put into your HSA health savings account, and it has a triple benefit. Number one, the amount you put in there, the $7,100, goes in pre-tax, so it reduces the amount of taxable income that you tell the IRS you made. So if you made $100,000 this year and you max out your family's HSA account, you will tell the IRS that you actually made
$92,900 or whatever it is. Yeah.
I'll do the math. What do you think?
Benefit number one. Benefit number two, that money is actually invested when in that account, and you could invest it into things like the S&P 500. So it can grow and compound. Any of the growth is tax-free.
But stays in the HSA?
But stays in the HSA.
Okay.
However, once you hit a qualifying age, I think it's like 65, then you can withdraw it for non-medical reasons.
So if I know I'm going to have we were talking earlier about LASIK or something like that, because some of us wear glasses in this room. If I know I'm going to do that next year, I might as well pay for it now if I have the money, put it into this HSA, and then I can pull the money out to pay for that procedure next year.
Yep. It compounds, it grows every year.
And if I don't use it, my $7,100 every year
just stays invested.
And it can also earn its own return the way that we've talked about compound interest. And all of a sudden I look up and I got a who knows how much waiting.
Yeah. That's kind of cool, huh?
Damn.
Damn.
Nita, listen, go back, play that again, start this today.
So we'll talk about some other things you can do with your money. So just write down, everybody, max out your HSA.
Max it out quickly. Listen to this episode fast and max it out quickly.
Okay. Loophole number 2.
Okay.
15 days of free rental income. The IRS allows you to rent out your personal home for 15 days without having to pay taxes on that income you earn from that rental. This may not sound like a ton, but some times of year or in some locations, you can rent things out at a premium.
Oh, yeah. I used to live in Atlanta, and the people in Augusta would all leave town when the masters came in because they could get a fortune for their house for the week.
Like $10,000 a day.
Yeah. I mean, ridiculous what they were making.
In fact, this is called, Chad, the Augusta rule. It was challenged in court for people that lived around the tournament who were doing that. I have friends that leave when the Austin City Limits concert comes in, the multi-day event, because they can rent out their entire house for a week for the same cost it would be for them to take their entire family on a vacation.
So if you live somewhere that there's a big event, think about getting out of town, renting the house because there's a 15-day free rental income opportunity.
Here's another example.
Okay.
Let's say that you have a business and one day a month you want to do your business meeting at your house or to have a barbecue or a client event or something else. Your business could rent out your house.
You're brilliant.
If you have a separate corporation, you could rent it out. So it's an expense to your business that you would pay an equivalent amount that it would cost you to rent an event center in your town, and you don't pay income tax on the other side.
I always thought
brilliant.
that I always thought that Ben invited us over to his house for the business stuff as like some
Camaraderie, right?
and like to welcome us into his home. But now I see.
Every time you've had dinner over at the Point, you understand that we
Now
were
I get
charging.
That the company was renting out the facility.
Understood.
The Augusta rule, number 2, ladies and gentlemen, rent your house for up to 15 days. It might be 14 days in a year, rent free, and potentially could be an expense to your business. Remember that we are not accountants. We are not attorneys. We do not represent anything. And most of the stuff we say is probably BS. So please consult a tax consultant and don't take any of our advice as something you should do. Disclosure, insert legal thing, asterisk. Let's go to the next one.
You just said exactly what I was going to say, except you said it very differently. Yes, very good point there, Ben. All right, take us to number 3. What is the number 3 loophole?
Oh, the Viva Las Vegas.
Sounds like
I know you
tax
love this.
deduction.
Where are we going?
He's
Where are
going
we
to
going?
love this. Turn my
If
house
you
into a
w-
casino. What?
Tax loophole number 3.
Okay.
If you win money on a gambling trip,
Yes.
you can deduct any losses from that same trip before you calculate the taxes on your winnings. You can only deduct losses up to the amount of your winnings, and you will have to itemize it.
Okay.
You have to keep records of how much you won and lost and where your gambling took place. On your return, you can also deduct reasonable expenses that incurred in order for you to win big on that slot machine or that craps table or that poker game. Reasonable expenses, Bob, could include things like travel to that casino or racetrack. The deduction had previously been available only to professional gamblers, but the Tax Cuts and the Jobs Act included us amateur gamblers, degenerates as well.
So this is, I mean, you're talking a scenario where you win enough money that they actually pay you out and they take your information to like give you get like a
$1,200.
a
It's anything over
1099
$1,200.
from them or whatever.
Let's
right?
say if you won some money playing slots or playing poker, you technically have to claim that as income.
Yeah, but who does
But if
that?
you
Nobody-
if you lost money the day prior, you can offset that by your losses, just
nobody-
up to the amount win. No,
nobody
wait a second.
goes to Vegas though, right?
But wait a second.
Okay.
That's not the key part. The key part is you can also write off
The
your
trip,
travel expenses
the
to get there,
plane, yeah, the hotel.
which maybe gives you a good way to save some money on a weekend trip that you needed to take to fuel your gambling degenerate ways.
You can't do this on losses, only on wins. Like I'm
You can only
Up to the amount
you
of
can
write
only
off your
deduct down to
losses.
the amount of the win.
exactly.
So you could basically wipe out that win and the income of the
got
win.
it. Got it.
Okay, number 4.
Number 4.
We'll call this the deadbeat friends and family deduction. If you loan somebody money and they never paid you back, like most of the people that I've loaned money to, and if you're listening, know it's you, you might be able to deduct it from your taxes. This deduction was intended for businesses, but the loophole allows anyone to deduct bad debt, even if the loan was made to a friend or family member. The loan must be considered 100% worthless and must be a debt, not a gift. This means that you must have come to an understanding, preferably in writing, that the money would be paid back. It also means that there has to be no chance that you'll ever get the money back. Often, this means the person who you borrowed from declared bankruptcy, or that you have called, sent letters, and made demands for repayment.
So if they're out of your life and they're not answering your texts anymore, et cetera, you could consider that's a reasonable loss.
Yeah, it's called the deadbeat tax loophole.
Ben, does this have to be within a certain period of time? For people who are listening who made a loan 2 or 3 years ago to somebody, can they still now go back and
I think bad debt counts anytime.
Again, go seek a professional opinion and all that. All right, next one, Ben. What's number 5 on your list?
The life insurance loophole. If you have a whole life insurance policy, not term life, but whole life insurance that has a cash value, you can borrow against the cash value in the policy. It works a bit like your IRA because the money in your policy that doesn't cover the insurance costs grows tax deferred. In this, it's called a whole life insurance. It grows tax deferred. You don't take any taxes unless you cash it out. Over time, you build up what's called a cash value in this policy, above and beyond your death benefit, the amount you get for your term piece of that policy. When you die, you get paid $1 million, or your heirs get $1 million. If you die, your beneficiaries get the death benefit, which is paid to them free of federal income tax. If your estate is large enough, they may have to pay a state tax on the proceeds. Meaning, this is a tax loophole for your heirs, but here's another way that's a tax loophole. You can borrow against the value of your policy, and you don't pay taxes on the amount you borrowed because you didn't actually cash it out. That make sense to you all?
Yep.
See how that's a loophole?
Yeah.
I read something the other day in the Wall Street Journal or New York Times that talked about how the wealthy, super wealthy, use debt as a way to avoid taxes. It's no different than you borrowing $100,000 out of your home's equity to buy a bunch of stuff, right?
Yeah.
You don't pay income tax on that because it's just debt. You have to pay it back.
Right.
Anyway, it's a tax loophole, something for you to think about. As I said, you can also take that loan out on your policy while you're still alive. This loan is free of income tax. You will have to pay the loan back, however, with interest. If you don't, the life insurance company will make the payments with the cash value in the policy. At some point, the payments could exceed your cash value and lead to a lapse. At that point, you would owe taxes on the amount of the loan that's more than the premiums you paid. If you die with a loan outstanding, the amount of the loan is subtracted from the proceeds paid to your beneficiaries, and you never pay tax on that income because you are now dead.
That's one way not to pay taxes. All right, what's next on the list, Ben? You've given us 5 great loopholes already. I don't know how many more you've got, but what's next on that list? Because I know you're not done.
The home office deduction.
Okay, this one I know. Keep going.
If you use part of your home as a home office, which most of us did during COVID,
Yep.
you can deduct a percentage of your home's improvements equal to the percentage of your home's square footage the office takes up. For example, if your home office represents 5% of your space, you can deduct 5% of the cost of installing central air, repairing your furnace, whatever that might be.
Yeah, your electric bill, your gas bill, all that stuff. Yep.
If clients come to your home office and the presentation of your home is important to your business image, you can even deduct things like landscaping.
Nice.
But here's another thing. If you have a home office, stay with me here, you don't have a commute. Because you don't have a commute, all the miles that you drive from your house to anywhere is a business write-off.
Right.
Traditionally, the miles that you drive do not count from your house to your office. Those are exempt. But since you have a home office, basically every mile that you drive that's business related to get gas, anything, is actually deductible miles.
So, Win, Make, Give listeners, since we have so many entrepreneurs that are out there listening in our audience, if you don't have a home office, go build a home office immediately. Turn a nook of the house into a home office. Go to the desk, pick a Post-it note up, make your first call from there for the day. You have now gone to your home office. You can now write off that relation of size into your home, and now your miles count as soon as you step out the door.
Bob, you should probably turn your basement into the recording studio home office, Right. Okay. Next one.
Or like put desks on opposite sides. So I'm like, sometimes I go at this desk and then I walk through my office to the other desk.
What
on the
I
other
do.
side, right?
The
Like,
stand-up desk over there. Okay.
yeah.
Here's the next one, Chad.
Yep.
The 529 plan double dip loophole.
Wait.
Say that quick. The 529 plan double dip loophole.
You sound like an NFL quarterback about to call a play or something like that. Omaha. All right, tell us about this one, Ben.
When you use a 529 plan to pay for college expenses, you don't have to pay taxes on the amount you earned on the money you invested into the plan. In some states, you can also get a state income tax deduction for your contributions. If you qualify, there are some income limits for the 529 plan. You can also take advantage of American Opportunity Tax Credits or the Lifetime Learning Credit, which I took advantage of when I went to community college. So you can save by letting your college savings grow tax-free and getting the credit on top. This adds to the Lifetime Learning loophole, which is like 6.5, Chad.
Yep, okay.
The Lifetime Learning Credit is a tax credit, not a deduction. Do you know the difference, Bob?
So a tax credit is just straight up money
Straight up money off the taxes that you owe.
Versus
A deduction
reduces the income you're paying taxes
reduces
on.
your taxable income. Good. The Lifetime Learning Credit is a tax credit, not a deduction. For people who are paying tuition and related expenses for an eligible student, maybe for your daughter, that person could be the taxpayer or a dependent. To be eligible for the credit, you have a modified adjusted gross income limit. So make sure you look that up. But that could be a benefit if you're paying for somebody to go to college. Make sure you look up the Lifetime Learning loophole.
These are crazy. What? These numbers are too low. Like they got to adjust these up. Are you kidding me? Like who's paying for somebody to go to college at that single filer? What?
That's the adjusted gross income.
Yeah. But the 529 plan, if you're planning to pay for your kids' college, Bob, you can start putting money away every year into a 529 plan right now and allow that to grow and compound and take care of your kids' college.
Next on the list, Ben.
They have a 529.
1, 2, 3, 4, 5, 6,
Seventh.
7. So you're on 8.
No, I had 6.5, didn't I?
7.5. So we're on 8.
Okay. Anyway, the backdoor Roth IRA loophole. Ladies and gentlemen, some income restrictions apply for people who contribute to a Roth IRA. The Roth IRA allows you to set aside after-tax money for retirement and withdraw it, including gains, income tax-free. So no matter what it grows to, Bob, you don't pay income tax on it. However, there's a problem because there's a tax limit. For people who earn more than $139,000 for a single filer or more than $206,000 as a couple, you make too much to contribute to a Roth IRA. That sucks. However,
Oh, is this the double door back
The
loop?
double loop back.
this is the backdoor Roth IRA loophole. Here's what happens. You can contribute to a traditional Roth IRA that's not deductible, meaning you can't take a tax deduction on your contribution, but then you can convert the regular IRA to a Roth IRA. When you retire, you can withdraw from your Roth IRA without paying income taxes on the money you take out. There's also no mandatory distributions at 70.5 as there are with the traditional IRA. So if you don't qualify for a regular Roth IRA, put money into a traditional IRA and work with your financial planner to convert it into a Roth using the backdoor Roth IRA loophole. Are you guys all confused?
I mean, this feels like you can't
I'm
triple
gonna be
stamp a double
rewinding.
stamp, Lloyd. Like you can't triple stamp a double stamp. Like
Turns out you can. Okay, I'm going to keep going. I got lots more to go here.
A lot more. Oh my gosh.
All right, the personal pool deduction loophole. Ladies and gentlemen, if you install a pool for medical reasons, you could get a big tax break. A taxpayer who suffered from emphysema and bronchitis was prescribed a swimming regimen by his doctor as part of the treatment. He built a pool and was able to write off the cost less the amount that his home increased in value due to the pool. He could also write off the cost of the pool upkeep because it was medically prescribed.
So you're saying I need a doctor to get me a prescription for the hot tub I put in?
Exactly. It's going to help you.
If you're out there, call me.
It feels like it. Okay. Here's another one. The 6,000 pound car deduction loophole.
Yes.
The 6,000 pound vehicle tax deduction is a rule under the federal tax code that allows people to deduct $25,000 of a vehicle's purchase price on their tax return. The vehicle purchased must weigh over 6,000 pounds according to the gross vehicle weight by the manufacturer, but no more than 14,000. So if you're going to go buy a new SUV and you had a choice between buying a 5,000 pound SUV and a 6,000, you should probably get the 6,000 if it works for you and your family, because you get the immediate $25,000 6,000 pound vehicle tax deduction benefit. What are you thinking, Bob?
I mean, I'm over here Googling how much my car weighs.
The Ford F-150. Yeah, I just Googled the Ford F-150. It's not heavy enough.
Mine's not either. Mine only
Check
weighs,
quad cab.
Right, I'm going to have to put in some other things.
Put quad cab.
All right.
See what it says.
Mine weighs 4,300 pounds. I mean, I have a Lexus LS 450 big SUV, but it's only 4,300 pounds.
Sounds like you missed out.
Like, could I have bought it with like some sandbags in the back or...
Anyway, you bought the wrong vehicle.
What's any idea where that comes from, or what there's obviously a class of vehicles that they're right.
And there's also actually if you buy it for your business, there's also a bonus depreciation option that you can add where you can bonus, I think, up to the full price of a vehicle this year.
Really?
Something for you to think about.
It might be worth putting in that one option that you weren't thinking about, like the included spare tire.
Yeah,
it might
totally,
be the weight you need to
get that roof rack.
That's right.
Throw that roof rack on there.
All right, let's get to some serious ones.
Wait, those weren't the serious ones?
No.
Okay.
The IRA tax benefits. The contribution limits for traditional and Roth IRAs remain the same in 2021 at $6,000. So if you qualify for those, you can put $6,000 a year into an IRA or $7,000 if you're over 50. That is a win. So write down, Chad.
Yes.
$25,000 because you're going to buy a new SUV.
Okay.
Write down $6,000 because you're going to put money into your IRA.
I hit 50 now. I get to put 7.
Write down 7,000.
There you go.
Oldie.
Yeah.
Okay. Next one. 401k. If you have a company 401k, you can contribute $19,500 in 2021. The total, that's if you work for a company that has a 401k. Now, the company can match it, and it could contribute more, but the total amount is capped at $57,000 that can be put into your 401k in a year. Most people, a lot of people listening to this podcast may not be employees. They may be self-employed in some way. So their option would be a self-employed solo 401k. If you call your financial planner and set up a solo 401k, you can put a maximum of $58,000 a year into your solo 401k before tax. So write down $58,000, Chad, for you. Now we got 3 tax deductions already for you in this scenario.
Yep.
Still with me?
I'm with you.
For a solo 401k. For 2022, ladies and gentlemen, it's going up to $61,000. Plus, you can do a little bit of a catch-up if you're over a certain age. Talk to a financial planner. You can go to Vanguard.com and set up your own. There's lots of options for you, blah, 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 blah. Okay. Let me give you a couple more. This one's only relevant if you live in South Carolina. And this, Bob Stewart, this is the South Carolina's charitable deer meat deduction.
Why, like,
For individuals who
found this, there's 50 states. There's probably tens of thousands of tax code little hacks out there. You found this one.
Of course.
Shock.
Individuals who donate deer meat to charity qualify for a tax credit under South Carolina law. To qualify for the credit, you must have a license to operate, blah, 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 and you need to donate the prepared deer meat to a nonprofit. I like it. If you're a hunter, there you go. You're welcome. So, Chad.
Yep. You got me for a new car, Ben.
In the next episode, we are going to tell a super bizarre story about what happened at an investment property that I bought.
Yes.
At the end of that episode, we're going to talk about the financials of owning a vacation rental.
Yes, sir.
And we're going to talk about the tax benefits using bonus depreciation.
Yes.
So I want you all to listen to the next episode. However, Chad.
Yeah.
Bob, do you remember what the tax benefit of owning that property was?
Bob had the numbers, I believe.
What the tax benefit was? Oh, you're talking about from this?
The depreciation on the next episode.
$40,000.
It was $125,000 of income that you could deduct.
Right.
Yeah.
Okay.
Yeah. Which ended up being worth $40,000 to us in our
less
tax
taxes.
bracket. Got it. Okay.
Okay. So add up those first three numbers, Chad.
Well, Ben, I got $25,000 we said for the SUV. I got $7,000 for the IRA because I'm over 50. We had $58,000 for the 401k. I'm also throwing in the $7,100 for the HSA that we talked about at the beginning.
Good catch. Good catch. And then what does that equal?
I don't know. That's where I need Bob.
Oh,
Bob, 25,000 plus 58,000.
83 and 14, 97, 83 and 14, 97.1 is what you gave me there so far.
$97,100, Ben.
So you could have $100,000 worth of income this year that you didn't have to pay income tax on by simply doing those four things.
So
Repeat those for me.
$100,000, I can say I made no money this year.
Yeah, repeat those four.
All right,
HSA, max out.
Maxed out the HSA, bought a new car before the end of the year.
Paid payments on it. You're fine.
Yep. You have the IRA, $7,000 for me.
Put in your IRA.
And you had $58,000 into a 401k.
And you maxed out your 401k.
There.
Now, if you listen to the next episode and you bought a second home, we're also going to add $125,000 of
appreciation
of income deduction that you get to do.
Yep.
I want you all to think about what is your tax plan for 2022. Some of these things you may not be able to financially do all of it, but maybe you could do part of it. What if you put $3,000 into your HSA and you put $5,000 into your IRA and you contributed 10% of your income into a 401k and that was only $15,000 or whatever it might be.
Yep.
It's still better than you're doing now because most likely we're paying too much in taxes. So what I want you to do is I want you to create a tax-free life exercise where you plan for 2022 of how you're going to invest and use your money so that you personally pay less taxes.
That's what it's all about.
Then I want you to listen to the next episode because it's super creepy and weird. And just bear with us and just go through the entire thing. And I hope you enjoy both of these episodes from the Win-Make Griff.
Yeah, enjoy the story Ben's about to share with you. And folks, Ben just took us through 13 tax loopholes for you. This is an episode worth listening to again. This is an episode worth listening to once a month to make sure you're not missing out on these as you go through next year. Make sure you check what the numbers are. Those contribution amounts might change. And as always, seek professional advice. Join us in our Facebook group, facebook.com/group/win-make-give. Share this episode with a friend. They want to hear it. Share this episode with your accountant. They need to help you with all of these loopholes. And until our next episode, as always, do good.